Have you ever wondered how a lease payment is calculated? Well, you need to know four things. The fair market value of the asset that's being leased at the beginning of the lease, the residual value of that asset, which is what you expect its fair market value to be at the end of the lease term, and the rate of return that the lessor expects to earn on that lease. Once you know these four things, you can plug them into this formula right here. And the formula says that the fair market value of the asset being leased, in theory, should be equal to the present value of the lease payments that are expected to be recovered, plus the present value of the asset's residual value. So the lessor is basically saying, I'm going to get two things. I'm going to get lease payments, and I'm going to get the residual value. And after accounting for the time value of money, those things should be equal to the asset's fair market value. So once we plug in here, we'll be able to solve for the periodic rental payment. So let me show you how to do that with some actual numbers. Let's say that we've got these characteristics here of a lease. We've got a fair market value of $303,218 at the beginning of the lease. The lessor expects to earn a rate of return of 5% on the lease. It's a 3-year lease, and there is a residual value of $20,000. So the lessor is expecting that when they get this asset back at the end of 3 years, it's going to have a fair market value of $20,000. Now the question is, what amount would the lessor charge to the lessee every year for the lease payments? Okay, and so we can calculate that. We'll use our formula. So again, the fair value of the asset, which in this case is $303,218, is equal to the present value of the lease payments that are expected to be received, which we don't know lease payments yet. We will solve for that, plus the present value of the residual value. Okay, so the residual value is $20,000. To discount that to the present value, we take 1 plus R, which R is 0.05, 5%, to the third power. Okay, there's 3 periods. So that's how we discount the present value, or to get the present value of the residual value. Now, the amount expected to be recovered through the lease payments, we don't know what the annual rental payment is, but we do know how to discount it. Okay, it would be the present value of an annuity due for $1, okay, for 3 periods at 5%. That is 2.85941. So the annual rental payment times the present value of an annuity due, 5% for 3 periods. We take this, the product of this, and we add the present value of the residual value. That should give us $303,218. So now we can just solve. So the present value, the residual value, this amount right here is $17,277 if you do the calculations. Now, subtract this from this side and subtract it from here, and we get $285,941 equal to the annual rent payment times that present value of an annuity due factor. Okay, so now we just divide each side by 2.85941, divide this by 2.85941, and we see that the annual rental payment would be $100,000. So in theory, given these facts, the lessor should ask for $100,000 a year as the annual rental payment. That would be a fair price for this lease. Now, note something, okay? When we look at this formula, you can probably tell already, the higher the residual value is, the lower the lease payments would need to be. So, for example, if the lessee was trying to work out some way to have lower periodic lease payments, they could maybe guarantee the lessor a higher residual value. Okay, because the higher the residual value is, the less the periodic lease payments need to be.